in terms of earnings upgrades, where do you see possibility of earnings upgrade now? Because I think until the past quarter, I think people were still predicting that, this rest of this year is going to be good. But I think the credit growth is not really giving much confidence in growth. Neither is the consumption pocket. Where do you stand?
So the starting point, Mahalakshmi, for this is that where are the expectations low?
Right.
That has to be the starting point. It is lowest today in consumption.
So expectations not in terms of prices, but in terms of earnings.
In terms of earnings.
Right.
Where the growth has been beaten down and has seen 3 or 4 quarters of successive downgrades, that becomes your starting point for identifying where the earning upgrades could happen. So consumption is definitely one pocket. But as you rightly said, it is, as always, it's become a second half story.
Yeah.
Every time we say it will happen in second half. But this time, actually, there's been a multiple, I would say, bazookas which are at work, which is credit, easy liquidity, lower rates, lower income tax, and banks and NBFCs being encouraged to lend. So I think that the macro is there. The micro has to show results. No early signs as yet, I would say. But generally, I think we have to look there. I mean, from my perspective, we have to look there to find earning upgrade candidates. That's the starting point. Second is cement, for example. It has seen, kind of iffy up and down kind of last 2 years. There's no belief in EBITDA per ton going up. There is competition from, obviously too large. There's been consolidation, but the two large guys are also wanting to take market share. But if you look at the commentary in the last 1 quarter from some of the large, not part of these two groups, but some of the large cement companies, there seems to be an understanding that the pricing has to be held and the profitability has to be improved.
Right.
And nobody is going to fight for market share beyond a certain sensible competition. So I think that's the starting point for earning upgrades to start. They might get little help from lower commodity prices and all that, but that's a bonus.
Right.
And again, valuations are nothing is super cheap today.
Right.
But relative to their own history, one can argue that there is a case to be made there if the earning upgrades happen. So these are a couple of candidates.
So again, just delving slightly deeper on cement. So again, what do you see as the triggers? Only price? Because even demand is growing in single digits. And I think as far as I can see, most people are pinning their hopes on capex being the big driver, like government-led capex being the big driver, not so much the real estate demand. So one is demand driver. Are you really confident that the demand drivers will actually turn out to be, they'll be able to get something at least in higher single digits? So with slight price increases, I don't know whether you can count on that. You're saying prices at least will remain stable. And with today's prices, what is the return expectation?
So if you look at the demand side, you're right that it's not, not going up like a rocket the way the real estate demand and infrastructure demand was there last 2-3 years. And if you go back in history, when infrastructure cycle was not doing well, when capital goods as a sector was dead, people held cement because it was the safest way as a proxy to so-called infrastructure. Right? A safe proxy to. But somewhere it has got left behind because the actual infrastructure actually did well. 22 to 24. So there has to be some, conceptually speaking, there has to be some bridging of that gap. Demand is not going to be 10% or above. It's going to be 6 to 8%, which is not a bad outcome. And actually, ironically, in cement, a very high demand growth sometimes also fuels competition. So it's very counterintuitive. That you don't
fuel supply and then you anyway demolish.
So you don't want that to repeat, and I think the pricing discipline in this 6 to 7, 8% kind of growth is much more of a tenable argument as compared to a 10-12%. That is very ironic, but and it's very counterintuitive, as I said.
Right.
But that is how the sector is. So I think if you look at other sectors where they are trading at their 10-year peaks, and you compare that with cement, I think there is good re-rating potential. Stocks specific, the upsides vary a lot.
Right.
So I don't want to give numbers here.
Right.
But it's not insignificant.
Be fair to say that earnings in cement will grow in line with demand, which itself is in single digits. And today's prices, can they be justified?
I think it can grow faster than the demand. That's the argument. Otherwise, there is no real case. Although, if you look at it in connection to the rest of the market, where we are looking at 10-12% earnings growth rate in FY26 at best, which is also getting threatened by the way the environment in IT is and so on. I think it's not a bad outcome if you get 10-12% earnings growth rate at a valuation which is lower than your previous peaks or lower than your averages or lower than median. It's not a bad place to be, frankly.
But to get to 12%, you with 6%, 7% demand is like a 5% increase in
That's where the
prices. You think
pricing comes in.
that is possible?
Yeah, I mean the leverage is much more. In cement, the upside from EBITDA per ton can outrun the upside from volume growth. That's the nature of the P&L.